Hello dear students. So finally ICAI has released the suggested answers for financial reporting September 25. In fact, all the final papers. And one question where we had a lot of doubt, right? What to do with this 4B? And immediately after the exams, when a lot of students had asked, I had given out that both the assumptions are possible. And today, if you can see in the suggested answer, ICAI has mentioned that both the assumptions are possible. So the confusion that that marks will lose out marks and whether we should do discounting or not, that is now fully clarified. And a lot of you had asked, right, sir, we should write mail, you write mail. So I had also given out a document where I listed out the issues and see if you write an email, maybe it had some impact. I'm not saying only because of that it has happened, but yes, because of the mails and the letters that you had written or the issues we had raised, definitely ICAI has acknowledged. And if you see the suggested answer, you can see that they have given both the assumptions are possible for question number 4B. Apart from that, overall, if you see the suggested answer, those are in line with whatever I have discussed in the suggested solutions, both for MCQs as well as for descriptive question, except for question number 1, which again I'll come back to. But first, let us clear this 4B. So here they have given a very unique assumption. Okay. Considering effective interest rate as given only for calculation of finance cost without change in the initial recognition of loan, then alternative solution is possible. So those of you who have done in either ways, you would have got the respective marks. There should not be any problem. Then in question number 1, in the consolidated financial statement, I have one disagreement with what they have given. Okay, theoretically or conceptually, if you ask me. Apart from that, the solution is fine. There is no problem in the solution. So when we come to question number 1, there is this thing around preference shares. Okay, so here there are some preference shares, 10% preference shares of rupees 10 each in the subsidiary company. Okay, now this question is similar to the one which was asked in November 23. Only difference being there it was debenture, here it is preference shares. Now in India, if you ask me, preference shares are redeemable. And if preference shares are redeemable, which means that it has to be classified as a liability. It cannot be classified as a component of share capital or equity. However, what ICAI has done is they have considered this to be a part of overall share capital, and hence they have attributed this separately to the minority interest under owners. Okay. However, if you ask me, technically speaking, because preference shares, and we are talking about Ind AS and Indian balance sheets, it has to be redeemable, it has to be liability, and it has to be classified as a liability. That is my only difference of opinion in the suggested answer. Otherwise, if you see the the calculation of goodwill and all of those things, everything else is in line with whatever I have given as the suggested answer. So if you want, you can go through the video where I have explained all the solutions, and 4B I have explained both the solutions, and today we stand here that IC has considered both of them. And coming to MCQs also, whatever confusions were there, in one they have not given the answer, in second they have said no correct options. Other than that, whatever we have discussed in the live session, that is what is being considered as the answer. Okay, so hope the video is useful. This question number 1, treatment as preference shares, I'll create a separate detailed video where I'll be explaining how the answer has been derived and what